Hello, Stephen Cruz here. I'm a mortgage broker with Verico iMortgage Solutions, and in this video series I've been talking a little bit about the 8 mistakes home buyers make when arranging financing. And I went through in the previous video the 8 mistakes, and now I'm going to go in more detail with the rest of them. So what we're going to talk about today is mistake number 1, starting the pre-approval process too late. So that is a big mistake that I've seen many clients do, especially because there's a number of strategies we can do, especially for first-time home buyers. So the first thing is, as a first-time home buyer, you have a couple of things that you can do that other people can't. And the main thing is that you can utilize your RSPs as a down payment. So you can use up to $25,000 and withdraw that out of your RSP as a first-time home buyer. The key to success there is you need to have the money in your RSP for a minimum of 90 days. You have to pay it back over the next 15 years, but you can also withdraw the funds up to 30 days after you take possession of your house. So it has to be in there for 90 days, you pay back over 15 years, and it can withdraw up to 30 days after your possession date. So this strategy is really great for people who have saved a bunch of money but not in their RSPs. They can transfer it into their RSP, and then in April when they file their tax return, they're going to get some money back. Could be anywhere from 30 to 50% a return on investment, depending on what your tax bracket is and how much money you normally get back on your taxes. The other thing I've noticed is that some people have some debt, and if you have some debt, then if you start the process early, we can facilitate a little bit of a debt restructure so that you can minimize the payments and maximize what you qualify for. If you already have debt, then that works out really well. You don't have to be debt-free to qualify for a mortgage. There is a component that we utilize in our calculations that allows you to have some debt, but the less your payments are, the more you can qualify for. Really, the most important thing to look for is how much money you can afford. So if the bank or me or whoever tells you that you are qualified to purchase a house for $500,000, but the payments are a lot more than you really want to pay, then you want to look and see how much you can actually afford and what that results in a mortgage and a purchase price for you. That's more important to me than for you maximizing, because otherwise you're just making all of your income going towards your house payments, and that's no fun. You don't get to do any other things, and it's just not great. One other aspect that we can help you with if you go early enough in the process is to review your credit and make sure that everything's okay. I've had clients in the past who thought their credit was great. We've checked their credit just before they go to purchase a house, and there has been an issue. And it takes usually 30 to 60 days to connect with the credit bureau and get that updated and corrected if it's a mistake that's on there. And if there's something that you need to do with the borrower or the lender, your lender, then we have time for you to go and connect with them and fix all that stuff and have that removed and update your credit so you do in fact qualify. So that's the number 1 step, and this is the second video in the series. There's 7 more videos, I believe. So if you have any questions, please comment below or move along to the next one. Thank you for watching, and we'll see you again at the next one. I'm Stephen Cruz, mortgage broker with Verico iMortgage Solutions, and we'll talk to you soon.